Good day, ladies and gentlemen. Welcome to this information session here with us from Prebita Training. Today's session is on cryptocurrency and tax, an interesting topic. A lot of people are buzzing about it nowadays. My name is Cordelia Fourie, and I will be your presenter for today's session. Just a few big disclaimers before we start. We know we've labeled this session SARS's views and approaches. Now, ladies and gents, we are not spokespersons of SARS. We are not employees of SARS. We cannot issue any opinions or answer on their behalf. We merely labeled this session like this because we are going to talk about the information that SARS has made publicly available, and that is actually available on the net. We've just done a bit of research on what is happening, what has SARS says about it, and of course then what does the legislation say. So it in no way expresses SARS's personal view on the matter. It just expresses their feedback. What have they said on their websites and in legislation? The second big disclaimer, ladies and gentlemen, that we just want to point out: we're not here to discuss any trading strategies. We're not here to give advice on trading or investing or promote any specific kind of cryptocurrency. Our focus for today is solely to try and shed some light on the tax impact and the considerations surrounding cryptocurrency. And then the last disclaimer, which I think is just as important: we are not experts on this matter. I'm not sure if anyone can really call themselves experts on taxing crypto at this point, because it is still a work in progress. And the only thing that SARS has done up until now is basically to incorporate it into the existing rules. So an expert that can apply the normal tax rules appropriately, if they can do so in the context of cryptocurrency, they might then also be suitable to approach for tax advice on this. But it is still something that SARS is working on continuously, that they are engaging on with the regulatory entities, the Reserve Bank, and with the platforms and other entities as well. So on our agenda for today, we'll just briefly cover what cryptocurrency is, and more importantly, what SARS says it is for tax purposes. What are the tax rules then? If we look at the principles between revenue and capital in nature, accrual versus receipt, and then we ask a very important question here: the onus of proof is on the taxpayer. So does that then mean that an amount is taxable until proven non-taxable? We use the pun there and ask until proven innocent. It's not to say that being taxable is a bad thing, but it is an interesting question to ask. Does the taxpayer now have to prove everything if he doesn't want to pay a significant amount of taxes? We'll also address the matter of anonymity. What is the impact then of automatic exchange of information and the impact of the blockchain? Ladies and gentlemen, just another minor disclaimer. Today is not a session aimed to look at blockchain. It's impossible to look at that matter in 1 hour. We do have a lot of sessions at Prebita Training that deals with this. My colleague Lynette Berger is working on that, and you are welcome to contact her if you have any questions on that. So our aim is simply just to talk about how SARS is gaining information at the moment. Right, and then some other tax considerations that we're going to talk about as well. What happens if a crypto asset is then donated? What happens for VAT? And interesting, what is the impact of tax then on the value of cryptocurrency? What do we expect to see in that regard? Right, so starting us off with what cryptocurrency is. So SARS has included almost like a general definition on their website as well. They refer to an internet-based digital currency. So they start off with saying that technically it is a digital currency. It exists only in the virtual realm. So it's almost like something in the cloud that you cannot touch, you cannot see, but everybody's having a big hoo-ha about it. And SARS has gone and said that currency is not defined for tax purposes, but crypto is, from SARS's perspective, it's neither an official South African tender, it's not money that you can classify in South Africa, nor is it widely accepted in South Africa as a medium of payment. Some entities, I know Takealot has started accepting it, but it's not widely and generally used and accepted. So what SARS has then done is it changed its view. Well, not necessarily changed, it just took a a stance. It just made its view, rather than viewing it as a currency, it views it as an asset of an intangible nature. And they actually changed the legislation. The tax laws no longer refer to crypto as a currency, but as an asset. So they do see it as an asset, even though in terms of a general definition, it might be seen as a currency or an asset, regardless of that fact. And then Section 1 of the ITA also includes cryptocurrency under the definition of financial instruments. And this is very important to take note of, because that would impact the tax treatment of crypto when we look at CGT. When it comes to normal income tax rules, it might not have that much of an impact except for the valuation thereof. But this definition, the fact that it is specifically classified as a financial instrument for tax purposes, would impact the rest of its tax treatment. Now, please do distinguish between the tax definition of a financial instrument and the Financial Markets Act. The Financial Markets Act do not apply to cryptocurrency because it's not defined as a security. There's a big difference between that and a financial instrument for tax purposes. A financial instrument is basically just an asset similar to a share, for example, that you can trade on an exchange, etc. The nature of it just groups it under the definition of a financial instrument, but it's not to say that it is a security recognized on some sort of exchange. And then we ask the question, is the Reserve Bank regulating this? And at the moment, not at all. We've indicated a quote there from the Reserve Bank that they do not currently oversee, supervise, or regulate crypto assets. It was previously referred to as virtual currencies, but they do continue, and this is very important, ladies and gentlemen, because it does play a role in the information sharing and basically the million-dollar question that we're going to ask at the end of the session: how will SARS know? The Reserve Bank is continuing to monitor the evolving area. They are monitoring the entire idea of cryptocurrency, what's going on in it, etc. However, these assets are not guaranteed by the Reserve Bank. They operate completely independently from central banks and the regulation that is placed on that. There's no laws and regulations that specifically govern the use of crypto assets. Now, the problem with that is that there is no formal legal protection or recourse for users or for traders that use cryptocurrencies. Right, so we would have to rely on the general principles of common law, whatever the contract law says, whatever the courts of South Africa has held at the moment. And of course, that then results in you having to trade at your own risk, an independent risk. So nothing that the Reserve Bank can really offer you from a security point of view. However, what they do recognize is that the Reserve Bank doesn't allow is transferring funds explicitly to buy crypto assets. So what is allowed by them is then basically using your 1 million discretionary allowance or your foreign capital allowance of up to 10 million rand. If you have your TCS PIN, you can use that and transfer that offshore and do with it whatever you want. But transferring money explicitly for buying crypto assets might be a problem. Right. What they then do not allow, of course, is also transferring or any transactions where the capital or the right to capital is without permission of National Treasury transferred from South Africa, because that would constitute, well, not necessarily money laundering, but it is an unrecognized transfer of funds. So in that case, it would unfortunately include where you purchase crypto assets in South Africa and then you are trying to shift it across to another country to almost externalize your right to capital. So in that case, SARS would pick it up, also the Reserve Bank, apologies, would pick it up and they would stop you in your tracks there. Right, but they also acknowledge that cryptocurrency is not a legal tender and suppliers of goods and services may refuse it as a means of payment. Right. The FinTech work group also mentioned that crypto assets, they basically said it operates within a regulatory void. There's no globally harmonized approach, they call it. There's no position that the countries have taken collectively to resolve how are they going to treat this, especially on an international level, because it's so easy to transfer it between countries or because it is traded internationally. So then just looking at the tax rules, we've summarized here from a bit of research and a few articles that we found what the international trends are. And it's evident from this that the international standard, if you want to call it that, is in line with what we know to be true under our own existing legislation. So if we just take the USA, Australia, and Canada and how they tax their crypto transactions, it seems to be in the same train of thought. So any capital assets, any virtual currency that is held as a capital asset will be taxed under CGT rules. Any mining activities would be included into gross income. Australia also focuses, they predominantly talk about the purchase of goods and services. That would be disregarded for capital gains taxes if it is below a certain value. And that might be something that SARS could look at, having the same rule in South Africa. At the moment, that isn't catered for. But from Australia's perspective, even if you conduct business, regardless the value, that would then be ordinary income. In Canada, the same principles apply. Ordinary tax income when you receive cryptocurrency as payments for goods or services. So depending on what the transaction is in South Africa, we'll look at that in a moment's time, the rules might differ, but it's still taxable if you receive it as a payment. And then if you have a transaction, depending on whether it is capital or income, they would tax it differently. So all of these countries have more or less the same basic principles. And what we have in South Africa at the moment is that we still distinguish between this revenue and capital. And very important, that question we asked, is it taxable until proven otherwise? The onus is on the taxpayer. Now, not only to prove that it is revenue or capital in nature. Essentially, the taxpayer would want to prove that it is capital, because then it won't be taxed at the normal rules. It will be taxed at CGT rates, etc. But it's also, the onus is also on the taxpayer to declare their crypto transactions and remain compliant. And we'll talk about this again when we look at anonymity and also when we close off the session, because I think this is the biggest question that people have been asking. How will SARS know? What are they going to do if I don't declare it, etc. And for some people, it's not a big issue to declare. They don't mind. For others, especially if you don't really make a lot of not necessarily capital gains, but a lot of gains or losses on your crypto transactions, it might not really amount to a significant amount of tax, and that might change the situation. SARS has indicated that if you are uncertain whether you should declare or what is the tax implications, you might seek guidance through a private ruling. The process to get a private ruling might be a bit administratively burdensome, so I wouldn't automatically advise on that. But other than that, we have to distinguish between revenue and capital. Now, this is based on the intent of the taxpayer and the nature of the asset, of course, but in this case, the nature of the asset won't really make a difference, because whether you have a lot of crypto or a little bit of crypto, it doesn't change the intent with which you hold it. Right. And this becomes a bit difficult. It becomes a problem, because how do you prove to SARS that you don't intend to trade in cryptocurrency unless you are a miner? Of course, we'll talk about that in a moment's time. But if you buy and sell the entire day, you're basically the equivalent of a share trader, ladies and gentlemen. Now, of course, once again, unless SARS catches you on it, it is possible for you to fly under the radar, but I wouldn't advise that. I'm going to say that a lot in today's session, because SARS is developing systems that will eventually track you down. So I would rather come forward in the first place. But the intent is difficult to prove, because when we look at the issue of capital in nature, you're not prevented from selling your asset at the highest value. That doesn't mean that you are now a trader. But the problem comes in where you are trading frequently, because then that might be seen as a trading stock, and not as capital in nature. Now, we're not going to discuss all of the possible methods to prove, are you having a trade or is it capital in nature? The basic principle is, what is your true intent? Are you holding it purely for investment purposes? I want to sit on it for 5 or so years, or even just for 1 year. It doesn't have to be 5 years. There's no set limit in legislation for that, but just a longer period of time. But if I'm going to buy today, sell end of the week, buy again, sell end of the week, then it seems like you are speculating with it. Right. SARS's guide for CGT also indicates that the nature, given the nature of crypto and the extreme volatility, it's likely to be held for speculative purposes, which are revenue in nature, but it's not guaranteed. You are allowed to, and you can definitely hold it as a capital asset as well. Right. So SARS distinguishes between three scenarios. They talk about mining, which is basically seen as a trade. Now, they do give a definition here of what is mining. I'm not very tech savvy, so even after reading the definition, I was still left a bit in bomb shock. But this is what they define it as: the verification of transactions in a computer-generated public ledger by the solving of algorithms. Now, I'm sure all of you that are very tech savvy understand exactly what this means. For me, it's important to know that if you know that you are a miner, ladies and gentlemen, if you are trading in cryptocurrency, I'm sure that you are tech savvy enough to know that you are a miner or not. The trading part of it might still constitute a trade, but that's simply buying and selling on a crypto platform. But mining, in my opinion, you have to be quite tech savvy to be able to do that. And in this case, you are rewarded the ownership of new coins. Now, SARS sees this as a trade. They see it as trading stock. In that case, you will have difficulty to prove that it is not a trade. So they do see it as revenue in nature. We asked the question here, what about Section 9 Cap C? Now, what 9 Cap C does is it deems certain shares to be capital in nature if you've held it for 3 years or longer. Ladies and gentlemen, Section 9 Cap C cannot apply to cryptocurrency or crypto assets, apologies, because it's not a share. Section 9C is only applicable to shares. But of course, you can also then argue here with SARS and say, but initially we said capital versus revenue is based on intent. But from my point of view, I would agree with SARS. If you are mining it, then I don't think your intent is necessarily to keep it as capital assets, but it might be. So I'm not trying to say that you are wrong either. It might be, but the essence, the nature of mining is classified by SARS as more of a trade. And of course, you can ask the question, what if I'm doing this from home? Will it then spill over into things like home office expenses if it is seen as a trade? And possibly it would. Right, then you would have to go and consider those rules. We're not going to talk about that today as well. The second scenario that SARS then indicates is the investment, where you exchange it. You exchange crypto for other crypto, or just you buy and sell for investment purposes on an exchange platform. So this is typically all of the Binance and the Luno and all of those platforms that they have nowadays, or through private transactions. So any exchange where you buy it or sell it to realize a capital gain, that would be CGT. And in this case, it would only affect you when there is a disposal event. Now, we are going to talk about when should we be taxed, what should we be taxed on, how should this happen in a few moments' time. But please just keep this in mind, only where there is a disposal event. And when trying to prove or when trying to assess whether you are holding it for capital purposes or not, you have to assess what was your intention by the time you bought it, what was your intention during the time that you kept it, and when you sold it. So there are 3 stages that you would have to go and look at, and your intent at each stage in the process would possibly impact then on the assessment. And as we mentioned, you could sell it for your best profit. That doesn't mean you are now conducting a trade or conducting a business with a profit-making scheme. The intent, however, is very important, and it is sometimes difficult to prove or disprove. The problem is that the taxpayer will have to prove capital in nature. And then for the payment, if you use crypto for the payment for goods or services, it's considered as a barter transaction. And then it would be dependent on whether it is in a trade transaction or in a capital transaction, which we'll look at as we go along. Right, and it's important to note that just as the income rules, the taxing rules apply, in the same way the existing expense rules or the deduction rules will apply for income in nature or revenue in nature and capital in nature. So what we've done on the next few slides is we've just broken it down in what would then be the complete tax picture from what we know from tax legislation at this point in time. If you are mining, which SARS from a first point of view sees as a trade, so there you would have your trading stock rules. It's basically inventory. And in this case, it would be similar to your accounting principles with the exception of write down of stock. Now, before we even get to that part, please note, cryptocurrency is a financial asset, or crypto assets, apologies. I keep saying cryptocurrency. Please do note that I refer to crypto assets. I'm still adjusting to it. Crypto assets are seen as financial instruments. Financial instruments are never written down for trading stock purposes. They are always valued at the initial cost. Okay. So we'll talk about that when we get to closing stock once again, but please do always remember that. So in terms of tax rules, what happens then is you start off basically with your opening stock for the year, which must be deducted for tax purposes. Now, this is similar to increasing your cost of sales expense in terms of a periodic inventory system, which is equivalent to a tax deduction, more or less. So there shouldn't be any differences here, especially if you couldn't write it down for tax purposes. Then the values for accounting and tax should actually be the same, because any fair value adjustments that you might have had for accounting purposes, you would have added it back or taken it out for tax purposes anyway. And then for purchases, purchases, of course, may be deducted provided that it meets the criteria of Section 11A. So still working with our general tax principles. The idea of it is just so that if you are taxed on it as a share trader or a crypto trader, then you should be allowed to claim the deductions in line with the normal rules as well. So we just asked the question here, at what value? Ladies and gentlemen, whatever you bought it at, it would be based on the value that you paid for it in South African rands, of course, because we are working in South African rands in South Africa. I know that a lot of the platforms deal in US dollars. You could view your currency or your assets in South African rands, but you typically purchase it in dollars. Now, regardless of that fact, you will still have to declare it in South African rands. And when we look at the value of the sales, we'll talk a bit more about this. The problem is definitely keeping track of it, because even if I'm a share trader, a crypto trader, apologies, I'm starting to use those two terms interchangeably as well, a crypto trader, and I use the first in, first out method, which is typically what trading stock is valued at. SARS doesn't necessarily accept the last in, first out method, as far as I'm aware. But the moment that you purchase an item, are you accounting for it somewhere? Now, a lot of us don't have registered companies. We don't have complicated accounting books, etc. But if you are seen as a crypto trader, are you accounting for your purchase transactions anywhere? Or is there a record of it? Because the moment that you sell it, that item that you bought last week, technically you have to account for the sales price on that first item, and the gain or the loss will be realized on what based on what you receive for it now and what you paid for it then. Right, so it's not a total value. You can't say everything that I have now I'm going to average, unless you use the weighted average cost, right, which is also a recognized valuation method. But the record keeping here becomes a big issue, because I can guarantee you that not a lot of people have kept records. Individuals, companies might have kept records, but individuals didn't keep records of what the crypto was that they purchased. And if SARS deems them to conduct a trade now, it might be a bit of a problem. Right. I would advise in that case, it might be easier to do weighted average costs, but it might turn out differently when you start working with SARS. Right, and then on the sales side of things, of course, you must include it into gross income. And the big question that we ask here is when. Now, I read an interesting article about this where someone said, basically, you have to pay the tax for this, and you'll need to pay it from whatever cash you have available. SARS doesn't care. They're not interested in the fact of whether you've cashed out your crypto or not. That the reason for that, ladies and gentlemen, is because crypto is taxed on the earlier, this is the normal income tax principles, on the earlier of receipt or accrual. And what does accrual mean in the context of cryptocurrency? Usually, in the context of everything else, it means that you are entitled to it. You have not necessarily a legal right to it fully, but you have an unconditional entitlement to it. You can use it the way that you want to use it. Right. So the question we ask here is, do you have to cash out to be entitled to the funds or to be taxed on it? And the answer is, unfortunately, no. I know that's not what you want to hear, but it is the truth in terms of tax legislation at this point in time. Accrual, in terms of the established principles, refers to that unconditional entitlement. Ladies and gentlemen, if it is sitting in your wallet, which means you have crypto that you have purchased, and maybe you have crypto that you have sold. If you have sold it and the amount, I don't want to say the amount of cash because that's not typically what it will be, but the amount of proceeds, let's call it that. You have sold your crypto and there's an amount sitting in your wallet, let's say argument's sake, US dollars, that you now have to withdraw. The moment that it's coming into your wallet, even if it's not in your bank account yet, if you have control over it to dispose of it as you please, it has accrued for or on behalf of your benefit. You can use it to your benefit because there are service providers that accept cryptocurrency as a method of payment. So if I have crypto in my wallet that I can use for paying for Takealot products, for example, I received income that I can use to my own benefit. And in that case, you would have to be very careful. Of course, if it's a capital asset, then you would have to account for it on CGT rules. But the moment that you use that cryptocurrency, it would be a disposal, right? Or the moment that you use the amount that it is worth. Right. It's difficult for me to talk about it in those terms because you have your crypto and you have an amount that it is worth in actual US dollars or in South African rands. And that's also going to become a bit of a problem, the translation. When are you going to translate it and keeping track of that? But it doesn't change the fact that the moment you are able to use it for your own benefit, SARS has the right to tax you on it in terms of tax laws, whether it be capital or revenue in nature. And then, of course, when you do cash it out, ladies and gentlemen, then you have nothing to say about it because then you cashed it out, you took your money and ran. If it was a capital asset, it's CGT. If it was a trading income, it's gross income. Then you don't have two ways about that. And then we just clear it out here, even if you use it to pay for something else or to trade it for other cryptocurrency, then it still confirms the fact that it was at your disposal to do with as you please. So please be very careful with this if you are trading in it. If you are confident that you're holding it as a capital asset, this might not be a problem for you. But if you are trading with it, the time of accrual is extremely important to take note of, and probably to get tax advice on as well, if you can. Right. The value of the sales we mentioned earlier on is also a question you need to ask. It's the same principle based on the value that you receive for it in South African rands, even if it wasn't cashed out. Ladies and gentlemen, not cashing out doesn't mean it cannot be valued. The wallet might indicate an amount in US dollars, but then you can use the exchange rate. That's a basic calculation. The problem is that you don't see the income anywhere where it is not cashed out. That's what the $1 million question for today. But you can still value it. And based on whatever you sold it for, if you disposed of your crypto asset at that point in time, and you can translate it to South African rands, that is what it is worth. And then just for closing stock, in terms of tax rules, closing stock must be added back for tax purposes. Essentially, it would decrease your cost of sales expense, which is equivalent to an increase in taxable income. That is the essence behind it. And then the value thereof, ladies and gentlemen, it would be at cost. It may not be written down in value because it is a financial instrument. An instrument as defined for Section 24J purposes, which are interest-bearing instruments, those would be valued at market value. But for a financial instrument, a crypto asset, you're not going to write it up and you're not going to write it down. And financial instruments are not only shares. It's included in the definition. So the write-downs by definition wouldn't be allowed. Right, and then the other side that we mentioned would then be CGT. So for an investment, you would have your normal CGT rules. Base cost would be based on exactly the same principles as your purchase price, whatever you purchased it for. But the problem would come in with keeping track of it, of course, to prove your base cost, because that is also something that taxpayers need to prove. And the proceeds would be based on the same principles as your sales price that we discussed above. With base cost, we asked the question here, are there any additional costs that we may add to this base cost? Any setup costs, any borrowing costs if I had to now get a loan from the bank to buy cryptocurrency or crypto assets? Now, borrowing costs, unfortunately not. In terms of the 8 schedule, that is only allowed for very limited circumstances. And I think it's only allowed for buying shares, not for buying crypto assets. However, For setup costs, I am of the opinion that there's a bit of leeway there. Right, as from a holistic view of Section 20 in the 8 schedule that deals with base costs, there doesn't seem to be any significant additional costs that you may add. The general principles will prevail for now because there aren't any specific guidelines for this, but you could try your best and argue that your costs to obtain applications, maybe to purchase an asset with or to purchase an asset on, forms part of the cost incurred to acquire the asset. The legislation doesn't really cater for this at the moment. It doesn't indicate it specifically, but it's my opinion that there might be a bit of leeway. There might be a bit of a possibility for that. If you take fixed property as an asset, the cost paid for an estate agent to acquire the property might form part of the base cost. Now, it's not nearly the same as paying for an app to buy cryptocurrency. I am aware of that. But in my opinion, it is based on the same principle. I incur a cost in order to enable me to acquire the asset. So SARS's stance on this might differ, and my opinion is in no way a formal or a professional one. It's just the way that I think about it at the moment. Right, and then, of course, on the income tax return, there's also provision made under CGT for crypto assets as a financial asset or a financial instrument. And ladies and gentlemen, unfortunately, when we look at personal use assets, there's been a lot of debate with whether SARS should classify crypto assets that are used to buy personal goods. If I use it on Takealot to buy household goods or whatever the case may be, can it be classified as a personal use asset? It is a good suggestion. However, at the moment, because crypto assets are defined as a financial instrument, financial instruments is automatically excluded from the definition of a personal use asset. SARS's guide for CGT also indicates that it can never constitute a PUA. Unfortunately, that seems a bit unreasonable because it is possible that I'm holding it for personal use and I'm using it for personal use. But until further changes in legislation are made, this is what we're working with. Of course, your 40,000 exclusion per year for an individual would still apply because crypto assets are just thrown in with all of your other capital gains or losses. Right. And then just the last part that SARS indicated, the barter transaction. That would depend purely on what the transaction was for. Was it a revenue in nature? Was it a capital in nature transaction? And in that case, it would follow the same rules, trading stock rules or CGT rules instead. The proposal then, of course, that was made for this was that if it is used for personal use, then there shouldn't be any CGT, but we haven't seen that in legislation yet. Now, with regards to the proceeds, how you determine the proceeds for a barter transaction, that is normal barter transaction rules. What is the value of that which you get in return for that which you give? The cost, ladies and gentlemen, will not change. It will remain what it was because you paid for it what you paid for it, regardless of what you are going to get for it now. The same principle would have worked in a trading scenario. I paid for it 10 Rand, argument's sake. I'm going to sell it at 20 Rand. If I trade it for something else, I still pay 10 Rand for it. It doesn't change based on whatever I trade it for. So in this very basic example, we just said, I have an X amount of cryptocurrency. I wish to trade it for goods with a value of Y. The proceeds would be the value of Y. That is simply what it is. The cost would be exactly the same. It would be whatever I purchased it for. It will neither be X nor Y because that's not what it cost me. This is just X is what it's worth for me at the moment. So I might make a profit or a loss depending on what Y is worth, but it won't change the cost. Right, and then just a few last notes from SARS's FAQ as well. How is it valued? They have confirmed here it is valued at what it is worth, the monetary value of that which is received. They do indicate here, and the answer to this question, in my opinion, was a bit vague because the person asked, should you who received cryptocurrency as a payment include it at the fair market value? And then SARS just said yes. So I'm assuming that means yes at fair market value. But the problem is, what time would you determine it at? And in my opinion, at this point in time, what the day you receive it on or the day that you pay it, that would be the fair market value, what it is worth at that point in time. But when you take into account delays in transferring it, between your wallet and someone else's or on the platform. Now, I know a lot of the platforms are doing it instantaneously, so you don't have to wait. But if it is on different days, it might create a problem for which SARS has absolutely no guidance at the moment. I suppose you could apply general logic. If you sell it and it's no longer in your wallet, if it has left your wallet, then you have to account for it as a sale on that point in time. When you receive it and it hasn't come into your wallet yet, or when you purchase it, apologies, and you haven't received it in your wallet yet, you would probably have to wait until you have received it, because you cannot account for it as a purchase if you don't have it yet. And then they have other questions here. What would be considered as acceptable proof of purchase? SARS has indicated that conventional receipts and invoices will suffice, which is a bit illogical because you don't receive conventional receipts and invoices for cryptocurrency. However, a lot of the platforms have started doing like reports, transaction reports, which, by the way, is also how SARS is going to track it going forward, in my opinion, when they start liaising with the platforms, but not all of the platforms have it at the moment. So this is a big problem at the moment, being able to prove it because you don't have any type of documentation at the moment. Unfortunately, that's a problem that I cannot solve for you. I don't have the answer for that. It would depend on what the platform that you are trading on caters for. Right. You could also use your bank statements as a method of proof. Unfortunately, that would require you to actually cash out. To be able to prove the cash out value for buying in, that might be a bit different because the bank statement might indicate the rand amount at which you bought in. So that could be one way of keeping track of it. And then they also ask the question, do you have to be the purchase price on the date, or does it have to be the average? And in this case, it would be on the date. You don't treat it as an average like you would shares. Right, there were other questions with regards to employment. What if I receive it for services rendered? It would follow the same rules, but then it would also be remuneration, which would attract pay as you earn. We also asked the question, what about other kinds of transactions? What about supplementary income such as interest or dividends? We know that it's possible for you to stake your crypto assets. It's almost like a pure investment where you only receive interest and dividends, and then whatever comes out at the end is what you get. Now, in this case, it will be taxed on the normal tax rules. The issue, in my opinion, is the source. How on earth is SARS going to determine whether it's locally sourced or foreign sourced, and how will the exemptions then apply? And for that, I haven't been able to find anything that clarifies this matter. So this is something interesting to see going forward, because in my opinion, it's impossible to determine the source because crypto isn't sourced from a specific country necessarily. It's there in the cloud, in the internet. So this is going to be interesting to see. Maybe they won't give you an exemption. Maybe they will. I don't know. Right. And then for non-residents, of course, it will be problematic if you look at South African sourced income for the same reasons. You also need to consider Section 24I. At the moment, cryptocurrency is seen as a foreign currency, or we ask the question, is it seen as a foreign currency? And to date, SARS hasn't issued any guidance on this. But if you look at the definition of foreign currency under Section 24I, there is a possibility actually that cryptocurrency falls within this definition because it's not regarded as a local currency. So there is an indication, but it's not clear cut yet. So we are hopefully going to see a bit of guidance in this arena, because if it is also a foreign currency and you're trading in it, then you need to apply the rules of Section 24I instead, which is a bit different from your normal income tax rules. And then the last question, what happens if I donate my crypto assets, or alternatively, if someone donates theirs to me? And because it's seen as an asset, you will have donations tax on it as well. It only applies to residents, of course, but they don't care whether it's a sourced asset or not, but you have to be a resident to be subject to donations tax. So you could consider the specific exemptions if it's a donation made in terms of a will, etc. And you can also apply the general exemption depending on whether you are an individual or a company. So the donor would be liable for donations tax. The donee wouldn't have any income tax on receipt, but please be aware of the income tax afterwards. If you are a trader, you might have income tax consequences, even if it was donated to you, because you can deduct it for trading stock purposes, but you will be taxed on it later. If it is a donee and you hold it as a capital asset, then you still might have CGT, even if you have received it as a donation. And then the interesting part, the anonymity part, the question that was asked there, how is SARS going to trace it? Now, SARS's answer to this was quite interesting because they mentioned here that they are granted a wide range of collection powers in terms of the Income Tax Act as well as the TAA, the information gathering powers. Enforcement and audit processes are confidential, however, and are not shared with members of the public. So what they actually said is, we're not going to tell you. But when you read the Act, SARS has the right to require certain third parties to submit information when they make payments to the taxpayer or when they facilitate transactions on behalf of the taxpayer. So it's not clear what SARS requires of the crypto platforms at the moment. However, we do know that they have already started communications with some of the platforms, and they've also started communications with the banks and the institutions that deal with people's finances, and they've also started to ask the taxpayers themselves, do you have cryptocurrency? And ladies and gentlemen, if you lie to SARS, then you're basically digging your own grave. I have no advice for you in that manner, except for come clean as soon as you possibly can. Right. So the question we ask is, does SARS have the authority? In terms of the TAA, yes. Of course, you have to hold them by their own rules. They cannot breach the boundaries of what they are allowed to do in terms of the TAA, but they can go to third parties and ask for certain kinds of information. Right. We are going to talk about Poppy in a moment's time, but just to deal with this question, is it still anonymous when you cash out? Ladies and gents, then the bank is involved. So unfortunately, you're not going to be able to get away with it that easily. Right. It is still a bit anonymous. SARS doesn't know your name and all of your family history, etc., but they can trace the transaction. And SARS will have a system eventually to trace this. So please don't try and run away for as long as you can. It's your runaway road is going to run out some or other time. It's going to end. And then the issue with Poppy, of course, when you ask the question, is SARS allowed to access such information without the consent of taxpayers? Once again, the answer is yes, if it is in line with the TAA and what is allowed to them, or what they are allowed to do in terms of their administrative rights and administrative authority. Now, ladies and gentlemen, SARS is not going to ask for super personal information. They want to see the transactions. They don't care about your medical history and all of the other sensitive information that you don't want them to know about. They just want to see what is going on with your finances. Right? And in that case, they can approach the banks for your financial information. Of course, they would have to have a valid reason. So there might have to be a backing. Maybe you are seen as a risk individual, whatever the case may be. You bought excessive amounts of assets with your crypto or whatever the case may be. So linking Poppy with what SARS is able to do, they do account for it. They do still have the recognition of what is allowed in terms of Poppy, and they cannot breach it. But unfortunately, the TAA, I don't want to say it supersedes Poppy. I'm in no way saying that, but it does provide them administrative powers in order to facilitate tax collection. The other problem with Poppy is simply the risk of publicly available information. But that's not SARS's problem. That's just based on the nature of cryptocurrency and the fact that everything is on the web and it's online, and how this might be infringing then on people's rights to privacy. So yes, when we talk about blockchain technology, it won't be necessary to link the information that you want to a person's identity. But there are still risks that they would need to address. So SARS needs to consider how far they are allowed to go and when it would cross the line. But for the individual at the moment, just based on the nature of crypto, there is a significant risk on access rights, cybercrime, ransomware, all of those horrid things that we hear about that's happening on the internet, scams and hackers and all of that. So you please need to be aware of that. Even before you worry about SARS, please just have at least a bit of cybersecurity when you deal with these things. And then we mentioned automatic exchange of information earlier on, where we said that this is one of the ways that SARS will get the information. Simply, this is more of an international thing. In terms of inside of South Africa, they will be relying on the TAA rules to get third-party information. But in terms of automatic exchange of information, this is with tax authorities cross-border. that they are required to submit information. They basically collect financial information from institutions around the world. They also call it reporting entities or financial institutions that have reporting information that they need to submit. So tax authorities and financial institutions are simply working together internationally to make sure that they know about the financial information. They don't care about all of your personal stuff. They just want to ensure that you're not evading tax. That's all they're trying to do. Well, I would hope that that is all they're trying to do. I can't vouch for exactly how this AI process works, the automatic exchange of information. But what I do want to say is that I almost want to say guard against trying to hide from SARS and playing out the time that they don't have a system in place yet, because it is coming. Right, our other tax considerations was simply just for VAT. Trading in cryptocurrency is seen as a financial service. It's actually included specifically in the definition thereof. So it is seen as an exempt service, but of course then the exclusion in relation to commission-based services would also apply to that. Of course, if you only trade in cryptocurrency and you don't have any taxable supplies, then it means that you might not have to register for VAT. But you still need to know whether it is exempt or not. Don't just assume that you don't have to pay VAT on it at all. Because if you conduct a trade and it is a taxable supply, then you might have to register for VAT as well. And then we asked the last question here, what about the impact on the value of cryptocurrency? We ask here, will over-regulation basically kill the buzz? Or will it actually encourage people to invest? Because now it's safer to do so. Right, so this is something, just an interesting thought for reflection. Once again, I don't have a clear answer for this. I don't know what over-regulation will do about it. There was a comment that someone made that the government is going to basically take over. They're going to start over-regulating it, and then it might then have this impact. But some people might be of the opinion that we're still interested, we still want to trade, we still want to invest, so it doesn't matter to us whether it's regulated or not. We're in it for being in it. We're not in it because we can do illegal stuff with it at the end of the day, which is a good thing. Right. And then, of course, we ask the question, what about the man on the street? Right. What about the person that just wants to play around with it? They just want to have a small investment. They're not in it for the millions. Is it worth hounding them for taxes while there are large corporations that should rather be focused on? Now, SARS does focus on the corporations. I'm not trying to say that they don't. But this idea of requiring all individuals to submit your crypto assets, even if you might not even pay taxes on it, it seems a bit burdensome. That is why the proposal was made to amend the personal use asset element so that you can have an exclusion for it and you don't have to declare it. And of course, then following international trends, I know Australia has a rule where you don't have to pay taxes on it for a certain amount, similar to the CGT exclusion, but they have a specific amount even if it is used for not used for business purposes, but held for investment, but where it is almost like an isolated transaction. So people that just, oh, well, I thought I'd buy it and then I left it and then I got a cash out. So thinking about those things where people shouldn't be administratively burdened just because they are now dealing in crypto assets. Right, and then also, can SARS implement any incentives from a tax perspective to encourage taxpayer honesty? Of course, at the moment, taxpayer honesty is half encouraged, let's use that word, by not the threat, but the fear of being reprimanded for non-compliance. Unfortunately, that's the only way that SARS at this point in time can encourage compliance, is by reminding taxpayers of the severe penalties that you would be facing if you do not comply. But there is a long way to go here with simplifying the tax administration here with regards to declaring it, especially for people who don't receive a lot from it. If you don't get that much, then why should you be taxed on that much? And there were also other suggestions with regards to simplifying the valuation of cryptocurrency in exchange transactions in order to clear out that confusion of when should I now include it and how am I going to keep track of the value of it. But that's nothing official. It's still just a few good proposals, in my opinion. We do need to find a system where SARS and the taxpayer can meet each other in the middle. Right, so just to end off, we always ask the question, we've asked this question in our home office session and in our immigration session, is it worth it? And we also put this picture here of the tax admin headache, because I think this is going to create a lot of headaches for a lot of people because of this record keeping issue. So they did ask the question on SARS's FAQ, how do you declare it? And where do you declare it on your ITR 12? It would depend. So either you declare it as CGT or you declare it as a trading income or just an other income. Right, but it is provided for on the tax return. And yes, SARS is relying on taxpayer honesty for this, which, if we're being honest, isn't always going to work because people honestly don't want to pay taxes, right? So excuse all of the puns there, but it is true. The problem, ladies and gentlemen, is just because there isn't a specific non-compliance rule. You'll see here that the oh, I see. It's not on this slide, the non-compliance penalties. But SARS has indicated in their FAQ, just because you have crypto assets doesn't mean the normal non-compliance penalties won't apply to you, regardless of what the transaction was. And it also includes retrospective application where relevant and where applicable. So it's very important to declare when appropriate. Don't just leave it because it won't be traceable, right? They'll never find out. And taxpayers cannot claim ignorance at the moment. Ladies and gentlemen, information on this topic is very easily available. Everyone is literally talking about it and asking about it. And if you are seriously doing the crypto thing, if you are now becoming a trader, SARS might turn around and say that you didn't take proper care of your tax affairs, which, so by the way, was part of a court case, I think, last year, where the taxpayer actually was subject to penalties and interest just because they didn't care about their tax matters. Now, I know that there aren't any third-party submissions for this at the moment. If you think about your IT3Bs that the bank submits, the bank only gives SARS a certificate to say, Corlia earned this amount of interest for this year of assessment. So the admin is your problem, unfortunately, but SARS could still find out if you don't tell them. So don't wait until it's too late. The million-dollar question here, how will they know? Right, I do hope you can see the $1 million there in the background. How will they know? Well, I don't know at this moment how they will know, but it is coming. They are asking for the information. They are liaising with the institutions, with the platforms. I know that Luno, one of the trading platforms, has started liaising with SARS and interacting with them with submitting documents, etc. That SARS has requested, of course. And you need to be careful with that, especially if you are an individual, ladies and gentlemen, because trading in cryptocurrency is actually a suspect trade. So, by the way, you would have to distinguish, of course, between tax evasion and tax avoidance. And in no way I'm trying to say that suspect trades are either one of those, but based on the penalties. Right? If SARS catches you and you have conducted a suspect trade and SARS sees it as tax avoidance or tax evasion, the penalties would probably increase there, and other horrid things that might happen to you in the long run. Right. But in terms of a suspect trade, it doesn't mean that you are in trouble automatically. Suspect trade simply just means you cannot claim losses on it, or the assessed losses would be ring-fenced on it, unless you can prove that it is a proper viable trade. But if you just incur losses just because you want to, then unfortunately SARS is not going to allow you to deduct those losses for tax purposes. And we know that SARS has started investing in their IT capabilities. We've seen that in the budget review where they were given quite a large amount to invest in that. So I would actually advise, if you are worried about the fact that if you declare it now, you might get into trouble, try and enter into a VDP, a voluntary disclosure program with SARS, because then at least you might get away from the penalties and interest, and you can get your conscience and your tax returns cleared out of the way. And so we have put a few resources there for you from SARS, from the Reserve Bank, SARS's guide, the FinTech Working Group's position paper on crypto assets as well, just with regards to the regulatory aspects of it. But those are all for your reference. That is then the end of this information session. Thank you so much for spending the time to listen in on it. I do wish you well, and I do hope to see you again in future. Right, if you are interested in any of our Pro Beta training manuals or guides, the links are also in the slides. You're also welcome to send any questions to us. If you have any, we will deal with that as and when it comes in. So you are welcome to contact us if you need anything from our side. Thank you and goodbye.